our latest private client intermediary update. As ever, we've got a full schedule for you this morning. Can I have the next slide, please, Maria? And you'll be pleased to hear that, given the croakiness of my voice, I'll only be providing a very brief recap on the autumn budget and spending review from a private client perspective. My colleague Wayne Dustin will then provide some practical insights on the hugely valuable business property relief. And following this, by popular demand, Karen Ranney and Craig Aspinall from our tax dispute resolution team will provide an update on current HMRC activity, nudge letters, and the Eclipse settlement opportunity. Following this, my private client colleague, Tim Lynch, will then provide a timely overview on the 5th Money Laundering Directive in respect of the Trust Register. And then finally, to bring matters to a conclusion, Laura Stuffings, who is a partner in our BSO team, will provide an introduction into our ambitious entrepreneur initiative and how this may be supportive to your relationships. As ever, this session is recorded and will be shared after the event has finished. We will also leave time for Q&A at the end, but please use the chat function to raise any questions during the presentations. Next slide, please, Maria. So, from a personal tax perspective, we said that we provide an update in terms of the budget. Next slide, please, Maria. However, it was quite notable in terms of announcements which were not made. On this page, I've summarised the changes to income tax rate, which actually we didn't really have any. We didn't have any material changes, which in turn leads to a fiscal drag and does increase the tax incidence over the course of Parliament. Next page, please, Maria. We obviously did have significant noise around potential changes to inheritance tax and capital gains taxes. And again, these were unfounded, in turn providing some degree of certainty for taxpayers in the short term. As noted, there were no material changes from a CGT perspective, albeit there was positive news in that effective from the 27th of October, the deadline for both UK and non-UK residents to report and pay capital gains tax after selling UK residential property increased from 30 days after completion to 60 days. When mixed-use property is disposed of by UK residents, legislation will also clarify that the 60-day payment window will only apply to the residential element of the property gain. Next page, please. As noted, there were no changes around inheritance tax, with the thresholds remaining at their current levels through to 25-26, which is the end of the current Parliament. Wayne will touch on the importance of business property relief, and no reforms to this and the other valuable capital release are also welcome. Next page, please. Again, there were no material changes for investors. Many will be keenly considering their options in view of the wider economic backdrop and the impact of rising inflation. One item of note is, however, the new 3-year fixed-term National Savings and Investment Green Savings Bond. This opened on the 22nd of October and will be for sale for a minimum of 3 months, providing an interest rate of 6.5%. Next page, please. And finally, on this rather busy but quite important slide, I've summarised the differences in the effective tax rates in view of the introduction of the new Health and Social Care Levy. As a reminder, the new 1.25% Health and Social Care Levy will be introduced from April 2022, and that is where NICs, or National Insurance Contributions, for working age employees, self-employed people, and employers will increase by 1.25%. In addition, the rates of income tax applicable to dividend income will also increase by 1.25%. So as noted, the dividend ordinary rate will be set at 8.75%, the dividend upper rate will be set at 33.75%, and the dividend additional rate will be set at 39.35%. The dividend trust rate will also increase to 39.35% to remain in line with the dividend additional rate. Now, these changes will apply UK-wide and take effect, as I mentioned, from the 6th of April 2022. And anybody that is considering cash extraction pre-5th of April, bonus or dividend planning, may want to just take some further advice in terms of what is the most cash efficient strategy for themselves and also for their businesses. So with that very brief recap, as I promised, I will hand over to Wayne.
So thank you very much, Vanessa. So in terms of this segment of the presentation, I have a number of queries have been coming across my desk in relation to inheritance tax and business property relief. And as this seems to be getting more and more popular, or maybe not popular is the wrong word, of more interest, then I thought it's probably worthwhile just giving a very brief sort of recap and overview as to what inheritance tax where inheritance tax can apply and how business property relief could also help. Just want to click onto the next slide, please, Maria. So my internet connection seems to be going really, really slow, so please do bear with me, because what I'm seeing on screen is probably not necessarily what other people are seeing on screen. But in terms of inheritance tax, most people know that, or will be aware that inheritance tax is generally payable on death or in relation to trusts. And so fortunately, the majority of my clients are choosing not to die, but when it comes to trusts, we are coming up to a number of events that can give rise to a tax charge. Specifically, if individuals are setting up a trust, then there could be an entry charge of up to 20% of the value that's going into the trust. There's then tax to pay every 10-year anniversary, and also if assets come out of the trust, there can be exit charges, inheritance tax exit charges. And generally, it's the 10-year anniversary issues that I'm seeing most of the interests and inheritance tax exposure and the work that we're doing is arising in relation to this. And typically it's coming in relation to existing trusts that have been in place for a number of years, and they are coming up to the 10-year point, and their asset profile may well have changed over the last 10 years. As such, it may be that historically the assets have been quite low value, so inheritance tax at the 10-year anniversary hasn't really been an issue. But if there's been a big increase in the value of the assets in the trust, or if the nature of the activities of the assets has changed, then 6% of a large number can actually still be quite a large number. And when we do get to the 10-year point, or indeed any exit charges or any entry charges, valuation is a big issue. So the assets that are going into the trust need to be valued. Valuation for inheritance tax can be different to your normal capital gains tax valuations, because what we're looking at generally is a diminution in value. So the reduction in the value of someone's estate pre and post transaction. So assets going into a trust, if you've got shares in a unquoted trading company, for example, you transfer shares into that trust, and as a result of that transfer, your personal holding goes below control, then actually a straight percentage of what you passed in might be a much lower value than what the actual reduction in the value of your estate is, because you've lost control. But also bearing in terms of valuation, when we talk about the assets, the value of the assets that's left your estate, that may be different to the actual value of the assets that qualify for business property relief. Okay. Just move on to the next slide, please. So what is business property relief? So generally, in the context of private company shares, it's 100% relief from inheritance tax for shares in a qualifying company. And I think, as you'd expect, a qualifying company isn't an easy concept to understand in terms of the legislation. But in terms of unquoted trading companies, it's a company whose business must not be wholly or mainly dealing in securities, stocks or shares or land or buildings, or making and holding investments. So, and an important distinction here is we're not necessarily looking at the company's trade, it's more the business. So a business is a wider concept, and it is more what is the company's activity. And that will include a trade or profession carried on for a gain. And we also need to look at that wholly or mainly test. So what you may find is that a company has got more than one business. So it may have what is effectively a trading business and what may be a property business. So I'll discuss in a bit more detail the property aspects shortly, but when you look at a company that's got two businesses, you need to see which is the main one. So if it's wholly or mainly a trading business, then potentially the whole of the value of the company may qualify for business property relief. That's regardless of it also having a smaller business, which is property, because when you look at business, you look at the activities in the round, and they must wholly or mainly be trading. I've just put on the slide there that there is a 50% relief for controlling holdings of a qualifying quoted company. We don't see too many of those other than companies that have gone through an AIM listing. So we may be dealing with clients who have held private companies that have listed and they've retained control of that business. But when we look at sort of unquoted, AIM is actually unquoted for the purpose of business property relief. So even if clients do list into an AIM company, then they can still qualify for business property relief. However, if they go towards a main listing, then we need to look at this controlling holding, and as I say, we don't see too many of those. If we can go on to the next slide, please, Maria. So when it comes to business property relief and private company shares, there are a number of concepts that need to be borne in mind. The first one is that there's a minimum holding period for an individual or a trust to qualify for business property relief, and that's 2 years. So you need to, once you've held your shares or your assets for 2 years, then you will qualify for business property relief. But we also need to bear in mind the replacement property provisions. So what may happen is that a individual or a trust may hold shares in a company which qualifies for business property relief, but there's subsequently a sale event. So what they do, they exchange their good assets for inheritance tax purposes for bad assets in the form of cash. So it's in that instance we've moved from a scenario where the trust or the individual may not necessarily pay inheritance tax on death, but the day after suddenly they've got assets that are subject to inheritance tax. There are, however, replacement property provisions which allow you to reinvest your proceeds from the sale into additional qualifying property, and you've got 3 years from the date of the transaction to reinvest. So what could be beneficial is if you've got an individual who has shares in an unlisted trading company, they sell their shares, realise cash, they've then got 3 years to reinvest, so they may reinvest in sort of other unquoted trading companies, or it may be that they reinvest in maybe into AIM shares. So when you look at the combined ownership period of the AIM shares and the shares in the company, if that is more than two years out of the prior 5, then that replacement property will still qualify for business property relief. So that is something that's important to bear in mind when advising clients, particularly investment advisors who may be looking at setting up certain portfolios or structures of a client's investment, because there may be some benefit in looking at AIM or BPO type qualifying investments post-transaction, because they may be able to extend the qualifying period and not necessarily start the 2-year period again. I put on their contracts for sale, so that there is a condition within business property relief that you will not qualify for the relief if the assets that you hold are subject to a binding contract for sale. So if there is a sale process and contracts have been signed, then there'll be no business property relief. It is worth bearing in mind, however, that options for sale aren't deemed to be binding contracts. So we normally see this more in terms of partnerships, but if you've got a partner who may sort of offer his share in the partnership to other partners on death, that the other partners have effectively got an option to acquire, then that's fine. But if the other partners are compelled to acquire the partnership assets on death, then that could compromise the business property relief position. The other point, or one of the other points that I mentioned on there, is groups of companies. So whilst a company that holds investments doesn't qualify for business property relief, a company that holds a controlling interest in other companies may well qualify for business property relief, provided those other companies themselves carry on qualifying activities. The definition of a group of companies here, it's more than 50%, but this is the Companies House definition as opposed to any tax definition, but broadly it just means 50% control or more. I put on their minority interests because it's worth bearing in mind that generally if a holding company has a minority interest in another company, whether or not that would be trading or a qualifying company for business property relief purposes, then minority interests are generally treated as accepted assets. I'll come on to accepted assets very shortly. There is an exception for minority interests where if it can be seen that the holding of the minority interest is complementary to the main activities of the group. An example of this may be for a haulage company which may have a small interest in a fuel provider, that could be argued to be complementary to the main interests of the main group. So you may qualify for business property relief on the value of the minority interests, but it is something that HMRC do look at. Interestingly, it's worth bearing in mind that if you do have a group situation with minority interest that may be excluded from business property relief, if those minority interests were held directly by an individual or trust, they may well qualify. So there may be some thought needs to be given in terms of structuring of assets in that instance. The other bit that I've put on this slide is in relation to partnerships. So partnerships themselves don't qualify for business property relief unless the partnership has got a qualifying activity. Typically using a partnership to hold shares in unquoted trading companies wouldn't allow that partnership or the assets in that partnership to value for business property relief. So again, there may be some merit in moving assets out of a partnership if business property relief is important to someone. Similarly, if there are partnerships in a group structure, then that may also be a blocker in terms of identifying accepted assets within the group, and it may be that assets held through the partnership don't qualify. I have seen arguments put in place and accepted with the HMRC that if a partnership holds shares in a number of qualifying companies and it carries on a specific business through that partnership, then the partnership can qualify, but it is something that's quite difficult and something that needs to be discussed with HMRC, if at all possible. If we can just move on to the next slide, please, Maria. So looking more at the accepted assets, when you're looking at a private company, when calculating the value of business property relief, the relief isn't available on essentially accepted assets, and those are assets that are not essentially needed for the purpose of the business. Typically, we see accepted assets as being cash, investment property, minority investments, which I've already mentioned, and intergroup loans. With regards to cash, we do see a number of companies that when you look at the balance sheets, they may have significant excess cash. I have just gone through an exercise recently where we've looked at a business that had very significant amounts and levels of excess cash. We're talking sort of tens of millions, and there was some real concern that this company wouldn't qualify for business property relief because that cash could be seen to be excess. However, when we went through the process of looking at what the company and the group does, and also the accounting reference dates, it became quite clear that this excess cash was actually working capital. And the reason being is that due to the nature of the activities that this company does, it built up some significant cash pots during the process of the year, and it did have some significant tax payments and payments made to suppliers, which were just after the accounting reference date. So it is worth bearing in mind that accounting reference dates are a snapshot in time as far as the company is concerned. And if you see cash balances on a company's balance sheet, that doesn't necessarily mean that there is an excess cash issue, but what it does mean is that you may need to sort of drill down and understand what exactly that cash is and what does it relate to. Is it necessary for the purpose of the business, or indeed is it required for future use of the business? It's worth bearing in mind that HMRC don't accept a war chest, if you like, that's been built up to sort of weather any particular storms as being necessarily needed for the future use of the business. So we do need to look carefully at any potential cash reserves. I think the other thing to mention on that slide is in relation to intergroup loans. If you've got a group of companies and you've got one company that is effectively advancing loans to other group companies, then generally that's fine, provided the subsidiaries or the other group companies themselves are carrying out good activities or qualifying activities for the purpose of business property relief. If, however, you've got a loan to a company which may be placing investments or managing an investment portfolio, then there is a real risk that that intergroup loan could well be seen to be an accepted assets in terms of business property relief. If we just want to move on to the next slide, please, Maria. Another point to bear in mind in relation to business property relief is, whilst an individual or a trust will get business property relief on shares in a company, loans generally will not qualify. So therefore, if there has been a transaction and some of the previous shareholders now hold loan notes, then it's unlikely that the value of those loan notes will qualify for business property relief, and therefore should anything happen to those individuals, then there could well be inheritance tax to pay on the value of the loan notes, even though those loan notes are advanced to what would otherwise be a qualifying business for business property relief. I've also put on here property businesses, because very often we see investors investing in property businesses, and I'm sure many of you are aware that property businesses can take the form of many guises. There is a specific exclusion from business property relief for businesses that hold land or property, and so at a very high level in the table there, property dealing businesses wouldn't necessarily qualify for business property relief, because all that they're doing is effectively buying and selling properties. An property investment company wouldn't necessarily qualify, because the holding of land to rent, for example, is deemed to be an investment business. Whereas if you've got a company that's doing property development, and sort of at the best end of the scale is that if what the company is doing is effectively just doing the development and not necessarily taking on ownership of the property on its balance sheet, then that should qualify for business property relief. If the company is sort of taking the property or the land onto its balance sheet and using that as stock, then ordinarily we would expect that to qualify for business property relief as well. But that then leads us into a position where we've got hybrid property companies. So you may have companies that do a mixture of property investment and property development. And the key here is to try and understand what is the main activity. Is it mainly development, in which case the development activity will qualify for business property relief? And similarly, if the investment activity is seen to be a business, then you may well find that the investment activity as well will also qualify for business property relief. However, if the investment activity or the dealing activity is the larger part of the company's activity, then you wouldn't expect business property relief to be available. And hybrid companies are actually quite complex and can be quite difficult to look at. So if you do have clients or individuals who do have interests in hybrid companies, hybrid property companies, then it is worthwhile having a chat with them in terms of inheritance tax and business property relief. Okay, that's really sort of all I wanted to say in terms of business property relief and inheritance tax. It is a very large topic on its own, and I could probably have filled sort of the whole hour of this webinar with business property relief if need be. So if anybody's got any questions, please do put them in the chat function. But I will now pass over to Karen and Craig, who will update you on tax disputes.
Thanks very much, Wayne. So good morning, everyone. So for those who don't know Craig and I, we are tax disputes specialists at BDO. So what does tax disputes mean? That means we get involved in helping taxpayers around complex HMRC inquiries, such as supporting tax avoidance arrangements and how people exit types of arrangements, or whether there's issues with HMRC. We support people with fraud investigations and at a very high level expert witness services as well, where there are claims that relate to tax. So next slide, please. So in terms of what Craig and I are going to run through today, so Craig is going to take us through a couple of very hot topics of inquiries that we're seeing at the moment where HMRC are very active. I'm going to touch on the recent HMRC announced Eclipse Film Partnership Settlement opportunity. I'm also going to walk us through what we're seeing in terms of HMRC activity where there have been either erroneous or abusive CGRS claims and how HMRC activity is really developing and ramping up. And then we're going to come back to Craig and he's going to walk us through HMRC's growing focus around crypto assets. So next slide, please. And over to Craig for this one.
Thanks, Karen. So the purpose of this slide really is just to give you all a bit of an update and an overview on some key areas. Like Wayne with his previous session, I could quite comfortably take an hour up just on these 5 topics. So the key is to get through it really quickly. So as Karen mentioned, CJRS and furlough, we're going to cover that separately, but that is probably one of the key areas of focus at the moment. Clearly, it's an area of public focus as well, hence the revenues focus on that. So we will cover that separately shortly. Offshore non-compliance, as always, in these sessions when we do TDR updates, offshore non-compliance is always a focus of HMRC. They're receiving ever-increasing data about taxpayers who have got offshore assets and offshore wealth as part of their No Safe Havens campaign. We've seen previously campaigns from the revenue, such as the requirement to correct, various different settlement opportunities for people who had offshore assets, which have now closed. Nudge letter campaigns being used by HMRC for offshore non-compliance. The key message there is that, if you have clients and individuals who you help who have offshore wealth, it's vitally important that they're keeping their tax affairs up to date on that, because HMRC really do have a focus on that area and will do so going into the future as well. Links us nicely into the nudge letter campaigns. We've previously done a session as part of this seminar on nudge letters themselves, but in real high level, what they are is it's basically a prompt from HMRC where they've got some information to suggest that an individual's tax return may not be correct. That said, we are seeing ever increasing nudge letters coming through, where particularly on offshore non-compliance and offshore assets, where actually the information that HMRC have received doesn't necessarily mean something's incorrect. They've just not been able to tie it incorrectly to the tax return. So, for example, offshore life insurance bond wrappers which have matured, HMRC won't have details on the 5% relief and things like that. So if a nudge letter is received, doesn't necessarily mean something's wrong, but they're continuing to be used. Some new areas of focus there that we're seeing more frequently at the minute are around person of significant control letters. So for individuals who are listed as the sort of main shareholder or main controlling shareholder, if you like, in a business, MBs, asking them to review their tax affairs and make sure they're considering a number of areas linked to that. And also capital gains on the disposal of UK residential property is also an area of focus at the moment with the rules that came in on those areas recently. R&D, appreciate that is a corporate issue, but just as an update, as I appreciate some of you may have clients who are very entrepreneurial and own or run businesses who are heavily involved in R&D, that is also an ever-increasing focus of HMRC's inquiries. They've actually got a dedicated task force now, which is designed just to review claims of R&D relief to make sure that they're correct. And we at BDO are seeing some of our clients and new contacts coming to us who have received quite wide-ranging inquiries into R&D relief claims, regardless really of whether any reports, etc., have been prepared by third parties. So, as always, protecting business value, etc., R&D is one of those areas which we would actively encourage businesses to be reviewing on a timely and regular basis. And finally, tax avoidance. As always, you'll see in the press, there's always press releases, etc., around tax avoidance schemes that are being defeated by HMRC through the courts. The key message we want to bring across here is that we are seeing more recently in cases that there is alternative analysis that can be agreed with HMRC that isn't just the usual taxing everything to pay as you earn an NIC. There are different ways of treating distributions into settlements, providing that the facts stack up and support the position being taken. So as always, the message is if there are individuals who are looking to exit an avoidance arrangement, the case needs to be reviewed on an individual basis to ensure that the facts are considered properly, to ensure that there isn't a better or sort of more efficient mechanism of taxing that, or a more appropriate mechanism of taxing that than your traditional pay-as-you-earn and NIC route. That leads us also nicely into the Eclipse settlement. So next slide, please, and back to Karen.
Thanks, Craig. So just on that last point there on tax avoidance, as Craig says, we continue to see lots and lots of activity from HMRC in trying to overcome, close down, encourage taxpayers to exit tax planning type arrangements. So let's not forget that these types of arrangements are very, very commonplace tax planning and financial planning a number of years ago, but which now fall within HMRC's space of what they would today view as tax avoidance. It continues to be quite a successful area of HMRC recovering revenues, and particularly where there is an element of economic uncertainty, it continues to be an area where HMRC recognise that they will continue to recover taxes relatively easily. And like I say, the success rate there in recent years has been pretty high. So that leads into, next slide please, the Eclipse settlement opportunities. So for those who are less familiar with the Eclipse partnership arrangements, these were quite complex financial arrangements which invested in films rights. And again, in today's world, HMRC would consider to be tax avoidance. So these arrangements aimed to, for members, generate quite large interest payments, and which could be offset against income tax liabilities. There were interest payments on bank borrowings, which fundamentally were presented as contributions to the Eclipse partnerships to make those investments in film rights. So Eclipse members effectively claimed relief for those interest payments against their income tax liabilities, and through the courts, effectively HMRC were quite successful there. There's been quite much publicised litigation around the Eclipse 35 partnership, where it was deemed that those partnerships were non-trading, so that fundamentally those interest relief deductions were not available. So there were 40 Eclipse partnerships in total, and as I say, it was Eclipse 35 that was litigated. So when that's gone through all the way through the court process, and ultimately HMRC have been successful, so that then leaves a lot of Eclipse investors in a position where they then decide, well, where do we go from here? Do we continue litigation on our partnerships, or do we seek to agree some level of settlement with HMRC? So therefore HMRC in September announced a settlement opportunity specific to Eclipse members, Eclipse investors. So there's a limited period here to reach a settlement with HMRC. HMRC have said that they are writing out to all Eclipse members, and people will then have 6 months from that point to reach a settlement with HMRC. Now, we've heard HMRC previously on other types of campaigns or initiatives say that they've written out to all people who potentially could take advantage of a settlement opportunity. I suspect that isn't going to quite be the case. So if you have clients of yours who you're working with, who you are aware have invested in Eclipse partnerships previously, it might just be worth asking them, have they heard from HMRC on this in terms of accessing the settlement opportunity, if that is how they wish to proceed. So very broadly, those settlement terms are about giving up that interest relief and settling the tax on those interest deductions that have been claimed, accepting that there could be late payment interest on that underpaid tax, and withdrawing from any legal actions as they relate to the Eclipse investments. And in exchange, HMRC is saying that they won't pursue members for the income tax on effectively the profits of the partnership, that those borrowings were treated as offsetting that income. But HMRC are also saying for those who don't accept the settlement terms and wish to continue defending their investment, HMRC will continue to litigate and will continue to seek to deny interest relief claimed, and also looking at tax charges, effectively dry tax charges on partnership income. So I think the quid pro quo here seems to be that for those who come forward, they'll mitigate or shelter the dry tax charge that could potentially arise if people don't choose to settle. But the thing I would say, as Craig alluded to before, whenever it comes to these types of planning arrangements, they're very, very fact and case specific. So it does require specialist advice. Next slide, please. And again, next one. So moving on to CGRS claims. So we're reflecting here to begin with some of the key facts linked to the CGRS scheme. So undoubtedly the CGRS scheme helped many, many businesses through difficult times, but it is fair to say it has been plagued with a bit of complexity through evolving and changing rules in terms of how claims can be made and the provisions around the amounts of claims that people are entitled to. But it has also seen a fair level of abuse as well. So just to recap on a couple of statistics here, the CGRS ended in September. So there were a huge number of people who were placed on furlough, and businesses were able to access this relief. So broadly, just under 12 million jobs were put on furlough during the period in which the scheme was available. So HMRC have paid out 68 billion under CGRS up to September this year. We can see that obviously as the economy started to open up, that the statistics show that as of June, the number of people who remained on furlough had decreased quite significantly. There is a bit of a profile around London and the South East having had some of the largest rates of claims and furlough. But in July last year, HMRC introduced the coronavirus support payment legislation, which was really designed to look at how we tax legitimate CGRS claims. Now, the bit here to just be aware of is that this legislation also looks at how taxpayers are treated if their claims have been incorrect or excessive in any way, and how those excessive amounts are recovered, but also the penalty provisions where potentially people knew or ought to have known at the time they made the claim that it was inappropriate. So it's looking at how we recover excess claims for those that were just innocent errors perhaps, but also for those at the perhaps more abusive end of the market. So next slide, please. So in terms of HMRC activity, where are they going with this? So HMRC estimate that 5.8 billion has been paid out linked to fraud or error. So HMRC, as of March this year, had opened up nearly 13,000 investigations into potential abuse, and 7,000 of those related specifically to the use of furlough arrangements. So HMRC have undoubtedly increased their resources, the number of people that they have now looking into potential incorrect CGRS claims, and that is both just having got things a little bit wrong because it was complex, so let's say innocent error, and the abusive end as well. But HMRC are reviewing some 28,000 high-risk cases that have been prompted in many cases through tip-offs. Craig mentioned the nudge letters earlier, so we understand that around about 80,000 nudge letters have been issued by HMRC as at October, and this is all about prompting, checking accuracy of claims because there was so much complexity as the rules changed and evolved. So next slide, please. So I just wanted to touch on some really common areas where we're seeing mistakes, where we're helping businesses review their CGRS claims. I'm not going to go through all the technical detail here as such, but just wanted to show really and reflect a few of the ways in which it's been quite easy for people to just get caught out in a very innocent kind of way. Because I would say that as a team, our employment taxes team are probably 90% plus of claims that they are reviewing have contained errors, and that's we're not talking about the abusive end of the market here. We're talking about people who have tried to get this right, but actually it's just been really complex. So businesses have made mistakes quite easily and quite innocently. So the bit to flag here is that we think HMRC inquiries will also come through businesses filing their corporation tax returns, because companies are now required to make disclosures in their CT returns as to the amount that they actually claimed, but also the amount that they were actually entitled to. So I'm not a betting person, but I know that I would suspect that HMRC, if they receive company returns that are claiming that what they claimed was absolutely what they were entitled to, I think HMRC are going to be very sceptical, and particularly the large business end of the spectrum. HMRC are going to be interested in any potential erroneous excessive claims and be looking to recoup those. And that's where that nudge letter process comes in. HMRC is writing out to people to say, do you want to just check the accuracy of your claims here? Are you really 100% confident that your claims are accurate, or do we want to do the right thing here and check the accuracy of your claims and repay the amounts that might have been accidentally claimed as excessive? So next slide, please. So just to summarise here on CGRS claims, so you've probably picked up by now that clearly this is an area of focus from HMRC at the moment, and the thing that we're encouraging all businesses to be doing is checking the accuracy of their CGRS claims, so that they can ensure that their CT return disclosures are accurate, and also so that they can be in the best position possible really to answer any of those nudge letters that might come, or where HMRC open up inquiries into how claims have been calculated. Partly this is a business preservation and transaction readiness thing as well, because you might be supporting businesses where they're looking at transactions on the horizon, and this is increasingly going to be coming up in due diligence processes, and understanding, are there any hidden issues here, any underlying issues that HMRC might then be pursuing the business in the next 12 to 18 months. So where people are coming up against issues and they've gone back and reviewed their claims and they realise that perhaps something was a little bit excessive, making a voluntary disclosure to HMRC is always going to be a much more positive outcome for businesses than waiting for HMRC to issue that nudge letter or to raise that inquiry and poke around and do their own investigation. You're going to end up in a much more better amicable position with HMRC. So as we said before, many claims are containing inadvertent errors just due to the complexity of the rules, not just the fraudulent end of the market where HMRC are undoubtedly seeking to correct issues. In those sorts of cases, that's where we're expecting there to be a raft of Code of Practice 9 investigation of serious fraud type inquiries. And again, that's areas that Craig and I support businesses with. So the message there really is any suspicion of fraudulent activity or deliberate overclaim of CGRS does need quite careful consideration in terms of how it's addressed with HMRC. So next slide there, please. I think we're then over to Craig on crypto assets.
Thanks, Karen. Just next slide again, please. So a completely different topic entirely to CGRS, but just one we wanted to just briefly update on is the sort of the HMRC's new focus, if you like, on crypto assets. So, you know, there is a growing volume of crypto investments, right the way from your casual investor who will just invest a few £100 on the price of Bitcoin, for example, right the way through to people who have been heavily trading in the crypto asset market. As I'm sure many of you will know, the crypto assets market has dramatically increased in value over recent years, with people making quite significant and substantial returns on very little investment at the outset, if they were savvy and or got lucky with their initial investments. And HMRC believe that there's an increasing amount of hidden wealth effectively because of the increase rise of cryptocurrencies and people being able to shift their money and investments into crypto assets. There's also a misunderstanding from the investors' side that HMRC have no visibility over the crypto market. It's regulated, etc. But there's a misconception there that there is effectively no way for HMRC to access this data. That's incorrect. As always, HMRC have a variety of different ways of getting information. And we're aware of a leading digital currency exchange that confirmed that effectively they'd shared details with HMRC of individuals who had crypto transactions of over 5,000, as it says there on the slide, in the 1920 tax year. We could only expect that to increase. We could only expect that HMRC will be able to approach more digital currency exchanges, investment sort of portfolio exchanges to request information be provided on the holders and sort of traders of crypto assets. Excuse me. There's also a misconception on the taxation of crypto. Now, we're not going to go into that on today's session, but you know, there's a common misconception that crypto is gambling, and obviously gambling is free of tax. HMRC have a completely different view and believe that crypto should be subject to tax, and therefore essentially want to ensure that those who are holding crypto assets pay the right amount of tax due. As we say towards the bottom of the slide, it's expected that there'll be a nudge letter campaign in the near future on this as well. So with the individuals and details that HMRC have got for those who have invested in crypto assets, that it's expected that they'll receive nudge letters from HMRC, most likely on the educational front, educating them in terms of how HMRC see the taxation of crypto assets, asking them to review their portfolios to ensure that any gains have been subject to tax appropriately, or if there's any individuals where they think there has been outright abuse or use of the crypto to hide assets, they may use a more strong nudge letter campaign or open more formal serious inquiries into those individuals or businesses. As ever, as we always say with these things, and as Karen said previously with CGRS, we really do encourage, if you have clients and contacts who are invested in crypto, that they're encouraged to review their position, review their portfolios, review their gains that they've made, to ensure that if there are any taxation issues arising from it, that they may just inadvertently had not considered, didn't believe appropriate, that they make the first steps to go to HMRC to seek to regularise their tax affairs. It's always the best way to go to HMRC voluntarily rather than wait for them to come to you. They'll be more amenable to discussing how things are taxed, etc. So the key message here is crypto is a fairly new area. It's an area that a lot of people don't know much about, and HMRC haven't really looked at in the past. However, as it's growing in focus, this is definitely going to be something which HMRC are going to review more heavily in the future. And I think that is us.
Thanks, Craig and Karen. Morning, everyone, and thank you for listening. I've been given the opportunity to update you all on the latest changes to the Trust Register as a result of the 5th Money Laundering Directive. Maria, are you okay to move on to the next slide, please? So, simply, the admin burden for trusts continues to grow, but we still believe that trusts are a very important tool for wealth planning and asset protection. So where were we? Under the 4th Money Laundering Directive, it was only relevant taxable trusts with a UK tax liability that were required to register. And those trusts continue to need to keep their registration up to date and need to make a declaration of no change by 31st of January 22, and then each year afterwards, or if there's been changes, they need to report those changes, which needs now to be done within 90 days of the trustees becoming aware of the changes. So we're now at the point where the 5th Money Laundering Directive legislation is coming into play, and this has extended the registration requirement to all UK trusts, with some exceptions. It opened on the 1st of September 21 for all non-taxable trusts. And the deadline to register is the 1st of September 2022, or from 90 days after creation if it's later than September 22. What's required on the register? It's basically any beneficial ownership information of a registered trust, and that needs to be updated, as I said, within 90 days of the trustees becoming aware of the change. Fortunately, non-express trusts are generally not required to register, and there are some types of express trusts that are excluded from registration unless they become subject to UK tax. Can you go to the next slide, please, Maria? And the 5th Money Laundering Directive also extends the requirements for non-UK express trusts to register unless they are within one of the exclusions. There's quite a few exclusions, but those that do need to register that are non-UK express trusts are those that have got UK tax liabilities. They'll continue to need to be registered. Any that acquire an interest in UK land or property on or after 6th of October. And those that we've at least one trustee resident in the UK that enter into a new business relationship with a UK relevant person on or after 6th of October last year. And for the purpose of this, a UK relevant person includes but is not limited to credit and financial institutions, auditors, accountants and tax advisors, legal professionals, trust or company service providers, and letting and estate agents. Can you move to the next slide, please, Maria? So the nasty bits around the trust register, other than the burden, are the potential penalties. Financial penalties have not been confirmed by HMRC, but we expect them to be in line with those that apply for under the 4th Money Laundering Directive, which is currently £100 if the registration is up to 3 months late, 200 if it's 3 to 6 months late, and 300 if registration is more than 6 months late. More serious penalties for money laundering offences may apply, but we haven't got details of what those might be at the moment. What we could see is that advisors and financial institutions may refuse to act for trusts that have not complied with the 5th Money Laundering Directive. I think that's probably very likely. And that is fairly it on the trust register update. If anyone's got any queries either now or at the end of the session, please let me know. Now pass on to Laura. Thank you.
Hi, good morning, everybody. My name is Laura Stuffins. I'm a partner in our business services and outsourcing team. And we support businesses both from those early stage businesses who perhaps have just got their first funding round, for example, through to growing businesses who need help to scale, go global, or perhaps looking to grow through acquisition. And we provide a range of accounting, compliance, outsourcing and advisory solutions to this part of the market. Today, I'd just like to take a few minutes to talk about our proposition focused on ambitious entrepreneurs. Next slide, please, Maria. And this is focused both on business owners, but also on investors and non-execs. It's not just about supporting a business or a portfolio of businesses from an accounting compliance perspective. It's about working together with the business to really drive growth and value. Our focus is on, firstly, building the right foundations for a business. So getting the business ready for growth, professionalizing how things are done. So that might be through optimizing the finance systems to ensure your processes are efficient, as automated as possible, and give real-time data. It's also about overcoming barriers to growth, be that freeing up busy business owners to focus on growth while we take care of the day-to-day finances, or perhaps helping to take the business international. It's also about maximizing the value of the business. So we're able to use our analytics and experience to easily interpret the value of the business, what's driving this, and ensuring the business is on track. And we do this by ensuring that, yes, the finance systems are robust, meet the needs of the business, and ensuring they're efficient, well controlled, and you're getting meaningful real-time information about the performance of the business. We also provide a fully outsourced finance function, which takes the strain and frees up time from business owners, but also allows the finance function of a business to scale as its operations scale. And our tools and our analytics allow us to delve into the business's finances each month to ensure the management information is not just P&L, balance sheet and cash flow, but actually provides bespoke KPI tracking relevant to the business goals and based on sector benchmarks, allowing the business leaders to make data-led real-time decisions. So whether it's supporting an entrepreneur in his or her own business through our outsourced finance function, or working with non-execs or investors to make sure they're receiving good, timely MI each month, or whether it's helping a business get ready for investment, our approach is very much bespoke to each business to get them in the best shape possible. As part of the Ambitious Entrepreneur Initiative we're running, there's also a series of roundtable events starting next year for business owners to come together and share their experiences and learn from each other. And there's several publications and webinars that will be running in the early part of next year. So if you're interested in these, or your clients might be interested in these, please do look out for those on our LinkedIn pages. Next slide, please. I also just briefly want to talk about our business resilience workshops, which might be of interest again to your clients or any of the businesses that you're working with. The business resilience workshops are aimed at the board or senior leaders in a business, and it gives them a chance to step back, take time out of the business with us, where we will help them look sort of where they're strategically focused and how they're going to get there. We run various diagnostics and benchmarking on the business to identify vital strengths, weaknesses, and risks in the business model and the operations. We hold workshops with the board or the senior leaders where we challenge them to ensure strategic success across all areas of the business, including people, markets, customers, skills, finance, and operations. And we'll help them prioritize the next step through an action plan bespoke to their business. And we'll work with the board from then ongoing to ensure alignment and make sure that their future plans are being taken forward. And the business resilience workshops that we've done over recent years have been particularly helpful throughout the pandemic, where businesses have had important decisions to make. They've increasingly looked to rethink their business models. They've had to perhaps pivot those business models according to different demands. And, you know, things have changed in terms of planning for the future. We've used our approach to support things like board strategy days, away days, because it really gives the opportunity for businesses to get an external perspective in a facilitated environment and get a different opinion on the business. If you or your clients happen to be based in the Liverpool city region, these business resilience workshops are actually available fully funded for those businesses, but it is a wider service that BDO offers as well. As I say, if you've got any questions on any of that, please feel free just to ask or drop me a line, and lots more information about how we support ambitious entrepreneurs will be on our social media channels, so Twitter and LinkedIn, in the coming months. That's all for me. Thank you.
Thank you, Laura. I'm sure that the business resilience workshops and the support that you've been providing to businesses, particularly during the pandemic and as we're coming out of it, has been hugely valuable. And then I think some of the material I've seen around ambitious entrepreneur in the last few months has been really valuable. And I know some of the entrepreneurs that I've spoken to have found it really insightful as well. So thank you for sharing that.
Yeah, that's right.
So that concludes our presentations for today, and we will briefly pause the questions. If you would like to ask a question, then please either submit it via the Q&A function or raise your hand. I know that Wayne has already addressed one particular question that's been raised so far, but Wayne, just coming back to you, if you wouldn't mind, and thank you for answering the specific partnership question that was raised, but there's been huge amount of noise around reforms to capital taxes, and we've had various reviews via the Office of Tax Simplification and from the All-Party Parliamentary Group, and just your thoughts in terms of whether or not we should be expecting any changes to inheritance tax and BPR in the forthcoming budgets would be helpful.
It is interesting because, as you say, we have heard lots of noise about this sort of thing, and we know that the government are actively looking at inheritance tax, but whether or not they've got the time or the appetite to actually make those changes at this moment in time, that's anyone's guess. So whilst we have seen a lot of commentary, I'm not convinced it's that high up on the agenda, but that's a personal opinion, so whether or not it does happen. And one of the things that we have seen talked about in one of the reports was the abolition of business property relief, and sort of the flip side of that was that the ability of certain businesses or certain estates that have an interest in unquoted trading companies, for example, the ability for them to pay any inheritance tax over a 10-year period. In my mind, I'm not sure that that's going to happen, because I think they're always abolishing business property relief sort of goes against the framework in terms of building up entrepreneurial activity and encouraging it. So if businesses see a huge tax bill on death, then maybe that's a disincentive for people to be entrepreneurial. I don't know which way it's going to go. Who knows? It's anyone's guess. But I think if I was a betting man, which I'm not, I'd probably say, regardless of any changes to inheritance tax, I'd expect there still to be some sort of relief there for entrepreneurial type businesses going forward.
That's great. And if you won't mind, just to stay with you, just on business property relief, you talked very much around the commercials and needing to drill down into the detail. And a number of businesses will have had their trading environment really skewed during the recent COVID period, and which I guess also picks up on some of the things that Laura was talking about. For businesses that maybe have got more cash on the balance sheets than they would have ordinarily done, is something that you're doing in terms of working with businesses to try and explain and to explore the narrative to make sure that they will be seen to be trading?
It is. It is key that we understand what this cash is for. If it's needed for the business in the form of working capital, or it's needed for things like future investment, which they've identified, then that should be fine for business property relief purposes. But what is interesting is that in the 2008 recession, I'm not sure everybody will remember that, but I certainly do. In the 2008 recession, questions were put to HMRC in terms of companies sort of holding war chests to try and ride out any sort of uncertain economic events. And HMRC did come back and say, actually, people just holding excess cash for uncertain events, we don't consider that to be a business activity. So I appreciate that businesses do like to have that little bit of reserve there, but it's not necessarily the best thing from an inheritance tax point of view. But that said, having the excess cash there may not necessarily compromise business property relief in the whole. It may mean that just the value of the excess cash is accepted from the relief, which may not be a huge issue, but it is certainly something to bear in mind. But businesses should certainly be aware of the issues of having excess cash or excess non-business assets on the balance sheet or in the structure, because it can compromise business property relief ultimately if it becomes an issue.
It's really helpful. Thank you, Wayne. Tim, if you wouldn't mind just coming back from a trust perspective. So many trusts have not been required to register under the 5th Money Laundering Directive today. And I see it quite a bit, and I'm sure you do as well, that quite a number of trusts don't always have liquid funds which are in place either to pay unexpected professional fees. So if we've got clients who are in the situation where they may need to take advice on this and to understand what their registration position is, and how would you go about supporting them to help them understand their position if they maybe don't have the reserves available?
Yeah, that's a very interesting question, Vanessa, and I think a lot of trusts are going to find themselves in that position. I think it's going to depend on what the assets are within the trust. As I mentioned, there are certain exclusions from having to register. So, if one of the exclusions, if the funds of the trust are less than £100, then they don't need to register. But for those that have maybe a property as the only asset of the trust, or maybe an offshore bond as the investment vehicle within the trust, those types of trusts won't traditionally have had to prepare tax returns or register previously, and would not have had to incur professional fees that would, other than their investment advisors potentially, which may have been taken from within the wrapper. But there are different options available. One may be to consider whether the settlor may be in a position to add further funds to the trust to help finance professional fees. Alternatively, if it's an offshore bond, it could be that the offshore bond needs to release funds into the trust, which can bring with it a whole raft of tax implications for the trustees and potentially the settlor if the settler's still alive. So there are ways to access funds to pay the professional fees, but they can bring other complications with them. With the trusts that I look after, who are in this position, I'm having conversations with them quite regularly about how they fund the fees going forward, and it just depends on the particular circumstances of those trusts. But hopefully that partly answers your question.
Yeah, and I think it's just a further reflection just to be proactive and to understand, what the clients have got within the trusts and what advice that they may need, isn't it?
Yeah.
And I guess this is maybe a question that sits between you and Karen from a tax disputes perspective, but we've heard about more trusts potentially needing to register. And this might be one for Karen, but are you seeing any issues arising from a tax disputes perspective in this regard?
I can take that one if you like, Vanessa. So I think the simple answer is yes, but it's probably first important to distinguish between the trust registration requirement and the requirement to register for self-assessment. So what we're starting to see is that lots of people who advise trusts, whether that's wealth advisors or lawyers, are, you know, naturally wanting to understand that the trusts that they act for are being compliant in relation to the trust registration requirements. But what we're finding is that this is kind of throwing up a number of cases where actually it transpires that the trusts haven't ever historically registered for self-assessment and haven't been filing returns for a number of years for whatever reason. Now, this could be just because perhaps these sorts of trusts started life as without there being a source of taxable income and having tax liabilities, but perhaps that's evolved over the years, but it's not been quite picked up just through innocent error, really, or trustees maybe not fully understanding their requirements as in relation to tax. So we are now starting to see some trusts arising where there's a need really to regularise the trust affairs, but you can understand that over a period of time that starts to build up between trust tax liability issues and also liability issues for the beneficiaries, because perhaps this has just been operating and bubbling away for some time without ever having actually been properly compliant from an HMRC perspective. So the short answer is yes, you know, and I'd be quite interested to see where HMRC land on the penalty position for the trust registration requirement, because I'd be, you know, you could question whether or not it's enough of a push, if you like, but I appreciate it is in line with other types of non-registration, non-filing, late filing type penalties that we see elsewhere within self-assessment. But I think it'll be interesting. I do think it will create, we've certainly seen some already, but I think there will be a volume of trusts out there who have some level of need to put things back on track.
Yeah, that's brilliant. And staying with tax disputes, Craig, if you wouldn't mind, if we're seeing the HMRC are increasing their focus, particularly around CGRS claims, is there anything in particular that you would be recommending that businesses should be thinking about now as a priority?
Yeah, you'll probably think that us in tax disputes sound like stuck records half the time when we're telling businesses and taxpayers to constantly review and always be reviewing, you know, their affairs. When it comes to furlough claims, I think it's the right thing to be doing, as Karen touched on in our sort of slides, that there are, because of the way it was introduced, there are so many ways that it could innocently have gone wrong, if you like, the claim, and errors be made in the claim. So given that HMRC are going to be actively looking at businesses and potentially all businesses, we just encourage, you know, everyone to review their claims, whether that be themselves or through a professional advisor who can help them review the claims, just to ensure that they're complete and accurate. And if there are any, you know, mistakes in there, put those right either before CT returns are required to be submitted or shortly afterwards, to make sure that you benefit from sort of the best amenability with HMRC when it comes to correcting errors.
Brilliant, thank you, Craig. We don't have any more questions, so with that, I'd like to hope that we've all left you with some positive food for thought, and some areas that you might just need to sort of reflect on and to think about in your own client situations. I'd like to thank you all for your attendance today, but I'd also like in particular to thank all the speakers who've given up their time and put the effort in for producing the content and for preparing their presentations today. Obviously, events like today don't happen without support, and for me, I'd like to say thanks in particular to Laura Myers from our BD team, and also to my PA, Maria Williams, who does a sterling job in the background in keeping everything running. A recording of this morning's presentation and the slides will follow. You've got everybody's contact details, and if you would like any particular support or just walk through any of the circumstances that we've talked around today, then do please follow up. Our next event will be on Thursday, the 10th of February, and I remain ever hopeful that at some point we'll be able to meet in person. I'll hopefully have my voice back, but in the short term, we will continue with this virtual format. As I say, if you do have any queries in the meantime, please do get in contact, and we hope to see all of you soon. Thank you.